Are AI stocks in a bubble right now? Many people ask me this question. Can they still buy or they need to hold on, right? And what are the opportunities that lies ahead? Hi, I'm Kathlyn from Beyond Insights, and I've been trading for 31 years. I'm very passionate to share about the stock market, and our company is an educator for financial investment and trading. Today, we're going to be discussing a very interesting topic about AI stocks in a bubble right now. Is that in your mind as well? I want to use this as an education as well on how to really detect whether it's a bubble or not. Are you ready for that? Listen for that. So since the launch of ChatGPT in November 2022, we have seen a boom in the semiconductor industry, especially for those stocks related to AI, with billions of dollars flooding into stocks like Nvidia, Broadcom, TSMC, Microsoft, and even AMD, right? And this is driven primarily by Gen AI adoption. Let's take a look at some numbers. ChatGPT actually reached 1 million users within just 5 days of its launch, right? Isn't that fantastic? Faster than any other online service in history, like Instagram or Facebook. What actually caused this big surge, right? A key enabler behind this AI revolution, particularly in the high-performance computing powering AI, is definitely Nvidia. Of course, this would not have happened if there's no usage scenario, right? So with the open AI research and announcing ChatGPT and the subsequent releases demands a huge computing power. Because of this need for huge computing power, Nvidia came in just at the right time. Even though Nvidia has been there, but they were focusing on gaming industry, high-end GPU for laptop and servers, they have not been focusing a lot on AI, but they came in at the right time with this high performance, and so happen it can be used for AI. So Nvidia stock has increased by more than 700% since November 2022. Of course, in between, there's some fluctuation between 500 to 700%. So many people actually ask me, 700%, right? Is it going to crash? Or is there still more room to go up, right? So I get these questions very often. And having gone through the .com crash before, right, during my early days of trading in the year 2001, I understand what a crash means and what can cause a crash. I don't think we are in a crash right now. Okay, I don't think we are in a bubble. I don't think we are in a bubble. But you have to be very selective on which type of AI stocks you're going into. Right? So do not generalize. But let me give you a flavor of the bubble last time related to tech, which is the .com crash way back in year 2000, right? During the .com bubble, guess what is the PE ratio for the Nasdaq 100? During the peak of the .com bubble, this is the PE ratio. Let's look at this part, right? During the peak of .com bubble in year 2000, Nasdaq stock traded at an absurd PE of 200. Which is more than 6 times of today's level, while the S&P 500 traded at PE of close to 45, right? So S&P 500 was not as stretched, although by the general average, it's still a stretched level, right? So where are we today? So let's look at what is the PE ratio for QQQ in Yahoo Finance. It is 40.78. But is this considered high or low? When we evaluate PE, we need to look at it by industry, and also by a run rate, like what is the historical PE. And we also need to look at the context to evaluate the PE. For example, during a boom time where a lot of companies making more money and the earnings growth is high, then it commands a higher PE. But during economic crisis where it's on a declining earnings, then PE should be low. So if during declining earnings PE is high, then it's elevated. But during accelerated earnings, a lot of times a higher PE is justified, just not excessive. Yeah. So we cannot just look at PE standalone. So we normally need to compare. So this is 40 compared to 200. So are we at a bubble right now? The answer is no. You can see here this is 40.78, but if you go to another site, which is gurufocus.com, right, then you can see the PE ratio here is lower, 31.64. Yeah, because they use a different calculation like a weighted average. Yeah? So in general, based on just the PE average, it is not in the bubble. Is way far beyond the bubble. So during that time, why it caused a crash is because there are a lot of new startup company, and because people thought that .com company can make a lot of money and need very little capital. So they thought their profit margin should be very high. But you see, not every company will make money. Right? It's not easy to really get the sales in, even if you have a great technology. So many of these companies doesn't survive. And when one, after that, 2 companies started to report earnings and show the reality, then people have a wake-up call. Because before that, .com stocks has been going up like 2 times, 4 times, 8 times, but the earnings is not catching up. Right? So there is a risk for it to crash due to that Yeah, so let me show you an example of the Nasdaq at that time. So let's look at it from the bottom before the increase in prices, right, which is 12 October 1998, to the peak of the dot-com bubble, which is March year 2000, right? The Nasdaq 100 has increased by 314+%. Can you imagine? This is an ETF, right? Nasdaq 100 consists of 100 stocks as a whole, ran up by 314 in just 1.5 years. So don't you think that is a bit publish, right? Stock going up doesn't mean that it's always become a bubble. But what is the fundamental that we need to evaluate? It is justified for the stocks to continue to go up, provided the earnings is going to catch up. For example, let's say if the QQQ has gone up by 314, does the earnings of these 100 companies on average justify this valuation, right? Does it go up by 300 over or at least 200 over %? Because we are talking about not just the historical earnings, but there is a high level of confidence that these earnings will come in the next couple of years to justify paying that much high right now. So what do you think is the answer at that time? The answer is no. A lot of the dot-com companies actually are not making money, but they spend a lot of money doing research. Right. Of course, there are few that did very well at that time. For example, right, Microsoft does survive, right? We have Google, Amazon, right? These companies are doing very well, and some others. But there were a lot where you cannot even remember the names anymore. So that's one of the important lessons that I learned, which is when the stocks start to go up, you have to make sure that it's justified with the earnings, current earnings as well as the earnings growth. Yeah, otherwise, it's just a matter of time. It will crash. Okay. And when more people wake up as a whole industry, that's where it will become more severe down. Right? As you can see here, this is a weekly chart. Yeah, it goes up gradually. Yeah, except for this part where in 1999 it went up very steeply. But when it crashed, when people wake up that it's become a bubble, right? Then you can see a very steep down here. And ultimately, if you move forward, it actually went even below where it started. It went below here. So it's very important to recognize a bubble. But for today, we are not at that level. And later on, I will show you an example for Nvidia. So one more lesson that is needed is to recognize just based on the technical chart, right? That's why I do believe that you cannot just rely on fundamentals, because fundamentals doesn't give you precise timing. Like it just gives you a scenario, or is the stock overvalued or not, right? Or undervalue, or how's the historical performance and the forecast. But it doesn't give you enough timing. Like, so people can still chase the stock when it's overvalued and overvalued. But from the stock chart, you can start to look at some potential risk sign. And when you see that it actually breaks the trend line, you could actually get out. Okay, so that's one of the biggest lessons I learned during that time. If you know how to get out here, you could have made a lot of money. Alright, so that's one lesson, 314%. So let's compare that with the overall S&P 500, right? Because Nasdaq is, a lot of it at that time are tech stock. During the same period, the chart based on the same period, S&P 500 only go up 68%, right? So it's not in the bullish scenario, right? Because a lot of stocks in the S&P 500 are also tech, but it has many other sectors at that time. It has 9 other sectors. So it didn't go up as much. But because of the panic at that time in the market, right, there's a chain reaction, right? When people are panicked, they sell everything. Like so, the S&P 500 also came down and went down below the level that I started here. Okay, so what are the lessons that you learn from this? Don't get hung up to, I'm not buying a tech stock, so I don't need to get out. Okay, from the stock chart, they sell everything, right? So that's the nature of the market sentiment. When people are panicked, it can cause a chain reaction. So do write down the lessons, because this could save you tremendous amount of money, like save in the market. First, make sure that you know how to get out. Okay. And let's look at something more intimate to me that I'd like to share. Like during the same period, I was working in Intel at that time, and I was granted stock options. And I have quite a number of stock options as a new employee at that time. When I started was way back in 1993. I joined Intel. Right, at that time, Intel stock was still quite flat. Right, then it went up the following year. Then it went up some more. Within my first 5 years in Intel at the time, the stock split 3 times in 5 years. And after it split, that means one stock become 2 stocks. Right, by right, the price will be divided by 2. Right, stock split is just it doesn't increase the value of the stocks as a whole, okay, or the company as a whole, but it just make it more affordable. But my share price after become half also go back to the original. That means the stock price double, and this happened 3 times. That means one stock become 2, 2 become 4, 4 become 8. And after that, let's look at what happened to Intel stock after that. it actually crashed all the way down. Right? Let's look at how steeply it dropped here due to the chain reaction where people are awakened. Right? These companies are not making double the money every other year to justify the stock going up at that rate. What I mean here is when my stock was splitting and going back to original price, means the stock double. Intel earnings did not double at that time. And when it did it 3 times, it's really very bullish. Right? So you need to recognize this part. And if I were to know that at the time, if I were to have this knowledge, I would have gotten out here. Even if 5% of what I know today, less than 5%, simple one is to use the technical chart where it breaks the trend line. And if you have a stop loss here, right, breaking the previous support, you would have gotten out as well. And you would have the warning as well because you know this is really overstretched, right? You won't be keep adding positions, right? So can you see how important is it to understand the stock market better before you actually invest in it, right? And people may think, oh, let's hold on to it, right? Wait for it to come back. Do you think it ever come back? So I have a question for you. How long do you think it takes for Intel stocks to come back to this level before the crash? Now, let me show you the truth. Right? This is the level, which is about 75 plus. Okay, so that was in August year 2000, right? Let's move on. Right? Let's move on. Did it go back? No. Okay, so let's look at 10 years later. Right, this is year 2000. 2010, it still hasn't gone up, right? And let's move even further apart. It still haven't gone up. Let's look at today. It's worse, right? It's down. Okay, of course, these are different reasons that affect it. Right, company-specific reason, not the industry level. Let's look at this. If you were to hold on for so long, right, it never come back to that level. So there's a lot of belief from people they don't want to get rid of the stocks because they still hope that it will go back one day. So this is where understanding the fundamental and technical is important, right? You need to understand that over here, the valuation is extreme and it's not justified. And because it's extreme and not justified, when people are awakened, people will not buy the stock until it stretched to that level. So you might as well just cut it off and start from scratch to screen the stocks, right? New stocks which justify the valuation. But otherwise, you would be stuck here. Although during that time they were giving some dividends, even with those dividends, you won't be able to recover back the loss here. And you would be better off to screen from scratch for stocks that are fundamentally strong, profitable, and has higher potential to go up. And that could even help you to recover some of the loss that you have earlier. Unless at the time you re-evaluate Intel, and from that perspective you see that okay, there's actually a strong profit and growth to justify for you to keep, then it's okay, right? Otherwise, you should have closed it and evaluate some other stocks. So let me show during this same period here, right, which is in August year 2000. If you have closed on the stocks that you were stuck during the .com crash, like in this case, just one of the examples is Intel. Right? Of course, you had to wait for the right timing, right, for the market to settle down because it's a systemic problem across the board. Once the market settled down, example here, if you were to invest in Starbucks instead at the time, you closed the positions that doesn't justify the growth rate and the valuation, and you start looking from scratch and buy a better stock, you would have recovered a significant part of the loss. Right? This stock itself, Starbucks, during this prime time here, it's just within a 3 years period, it ran up 378%. This is a very important psychology that I learned from teaching for many years and also from my personal realization. Right? Do not hang on to the stocks that you have. Many people cannot get out from, let's say, top growth, right? Harta Lega, because it hasn't reached back to the pandemic high. They say, oh, I really lose money. How do I cut loss? Right? So do you think top growth can go back to the original price? Okay, because now it's pandemic is over. The demand is definitely not at the peak like that time, and there's a lot more competitive right now, which is producing a cheaper growth. So, and do you think the profit and growth for top growth is as high as that time, or even right now, does it justify to go back to that level, right? If not, why don't you start from scratch? Right, screen, tops down screening, yeah, which is what I do. I start from tops down, which are the most profitable and high growth company, right? Then I look at the valuation, I look at the stock chart to time it. Okay, that would be a better deal, and you will be able to go into the right stock, and that would have helped you to recover back your losses and make even more. What do you think of this idea, right? Instead of holding on. So if you right now have any of the stocks that you're still holding on, I strongly encourage you to relook at what you want to do. Okay? Are you ready to take your trading to the next level? With the right strategies, you can actually start picking quality stocks and managing the risk like a professional. At Beyond Insights, we develop a systematic, versatile, and safe framework to help traders make smarter decisions and grow your investment. Why systematic is very important? Because without systematic process, you will not be able to repeat it. And why versatile? The market is dynamic, right? You can see election years versus non-election year and full wins that will chase the market. But more importantly, you need to be safe. You have a strict money management. So I'm inviting you to join our free 3-hour webinar where you will learn how to systematically do this, right? Which is how to find quality stocks, we call it select, right? How to find high growth potential companies and how to be versatile for different kind of market scenario. And last but not least, to master risk management to ensure that your reward outweighs your risk and you can sleep with peace of mind. So click on the link in the description below to join our free 3-hour webinar and start to learn how to trade or invest smarter. So another popular questions that I get all the time is Nvidia too high right now. Can I still chase it, right? So first of all, the word chase is already a bad word, right? So it's a bit of a FOMO, a fear of missing out. So how much do you think Nvidia have surged so far since ChatGPT was launched end of November 2022? Just a wild guess. Right, let me show you the actual over here. Since the launch of ChatGPT, which is on the 30th November 2022, until today, which is as of 28th October 2024, close to 2 years, Nvidia has gone up by 803%. That's 400% per year. So isn't that amazing? So isn't it very natural for people to think about, oh, is this going to be a bubble? Right? Will Nvidia going to be crashing? Let me show you Gen AI demand right now. So this is the forecast extracted from Statistical Market Insights. You can see the growth of Gen AI, right? And Gen AI is just a component of AI, right? So it's just a subset. But this alone caused a huge demand surge. From the launch in 2022, you can see it's just very small, $12.05 billion. And in 2030, it's forecasted to be 356. So do you think the demand justify the rise of these AI stocks? And of course, you need to look at which AI stock, right? Whether those companies are really able to capture this market. And do you think Nvidia is one of them, right? Definitely, Nvidia is leading in terms of the hardware side. And it has a lot of new technology on it, right? It has launched the Blackwell, which is a very advanced server, although there's some delay in terms of the delivery earlier due to some bugs in the chip, but they have actually resolved that. One of the very important sentences that I hear from Jensen Huang, right, the CEO of Nvidia, which is the demand for Blackwell, which is the latest product, is, he used the word insane.
Blackwell is as planned. And the demand for Blackwell is insane. Everybody wants to have the most and everybody wants to be first.
It's insane. I seldom see a CEO saying that. It's risky for them to say it if it's not true, right? They can actually get a penalty from the Security Commission. So the advantage for Nvidia is they are way ahead because they started from graphics card, which is quite similar in terms of the speed and the technology needed, right, for AI right now. So they were way ahead. Then the rest are just catching up. And even US, right, is actually having a sanction for China, right, to leverage on the chip. And China wanted to develop their own AI chip, but it would take some time. It's not so easy to catch up on that. And because the demand is right now, and in the next couple of years, it's going to accelerate even further, Nvidia has a huge advantage to capture this market. So one of the important things that I learned over the years is if the market is big, the worry about competition is smaller. Okay, if the market is small, then you're competing against each other to eat into the same pie, right? Let's look at the laptop environment. The laptop growth is very saturated, like PC is worse, right? It's declining. When the particular demand for a product is saturated, then competition becomes very significant. But if the pie is very big, right, then everyone can grow in that. There are many competitors that can still grow because there's a lot of fish out there. Understand? Yeah, so this is what I meant here. The demand is so huge that it's okay to have multi-players. Yeah, because we are in the boom time, right? We are not in the saturated time. You agree? Yeah, so most important is you want to invest in a company that are in the top 1 to 3, right? Not in the bottom part of the pie. This is an article that I shared with our students, right? This is our students' Facebook group on the October 10th. Nvidia actually published the latest investor presentation, which I shared with our students. This is actually very important, right? It's the revenue forecast for Nvidia. Let's look at their 2024 over here, 60.9 billion, because this is in millions, so this will be billion. And the forecast for the first half 2025 is already 56, very close to the entire year of 2024. So do you think the growth is still very significant next year? And this is from revenue. Revenue doesn't mean earnings, right? So this is operating income closer to earnings, right? This is a before tax. So you can see the earnings for the first half of next year is slightly higher than the entire of 2024. Okay, so I hope from this you can answer the question itself, right? Is there still more upside to Nvidia? Right? There's one more part, which is Nvidia overvalued? Right? So if you look at the PE, 66.32, in normal standard is overvalued. And this is where a lot of people have a wrong interpretation of PE, right? But based on forward PE, based on what they can earn next year, is 34.73. It is a bit stretched if you compare to the general valuation of the tech stocks. But the PEG, right? PE to growth ratio, which is PE divided by the next 5 years growth, is justified. It's still below 2. It's not very extended. Because you see, there's a lot of limitation for using PE. Because PE is the current price divided by the last 1 year earnings. It doesn't reflect on the growth in the future. And even forward PE is the current stock price divided by the next 1 year earning. But it doesn't show the next 5 years, right? And the one that shows the next 5 years is the PEG. And if you look at here, the earnings for next year for Nvidia is 43. Based on this, very high chance that it can exceed that, especially when you look at the figures I showed just now. And next 5 years average 35. This is actually a very high growth company. I'm not asking you to, this is not a buy-sell recommendation, it's not to buy right away, because one of the risks for Nvidia is on the sanction between US and China. Right, especially if Trump comes on board, you have a lot more sanctions on semiconductor restrictions here and there, even to export to not just China, but also to the Middle East, which can cause some volatility. But volatility doesn't mean it's bad, right? So what you need to do is to understand the fundamentals and to look at the stock chart to time during the pullback. The reason is this, right? If the demand is there and they continue to make money in the future, right, and you're buying at a lower price during the pullback, the market cannot discount too much on what the stock value is supposed to be. Right, so if given a couple of years, Nvidia fundamental intrinsic value would have been higher, which would justify the stock price, even though interim there'll be some volatility. That's why understanding the company analysis is very important, right? This is just looking at some figures, it's not enough, right? By right, you need to understand more of what Nvidia is using, what is the composition. Nvidia is more resilient compared to companies like AMD, right? Some people ask me, oh, why is Nvidia stocks going up so high, but AMD is not taking off? And in fact, in the earnings yesterday, AMD gapped down, okay? Because AMD has other major products, including the client computing, like PC and laptops, which are not recovering yet. And also they have the gaming. Gaming is not doing well. So that actually dragged down AMD performance. And also AMD doesn't have a strong chip to compete with Nvidia yet, right? It's still working on it, but it hasn't have a strong dominant chip in it. But if they continue to work on it, in the next 1 to 2 years, if they can come up with a great AI chip that is closer to Nvidia, then the stock can take off, because there's enough demand for more than one player, right? And it's all about not just performance, right? It's also about pricing, right? So as long as they price the product right, then they can still sell. Just like we can have a Nvidia gaming card and also AMD gaming card, right? And we have a AMD chip and also Intel chip, right? The market can support multi players, right? So I hope this can give you some idea in terms of the potential upside. This is just my personal opinion and assessment that there's still room for Nvidia to grow because of the high demand for AI. And what I cover is just Gen AI. There's also demand in automotive, right? There's also demand in healthcare. There's also demand in a lot of analytics. If you sum up overall, there's still a huge demand on AI. But you need to be very selective, right? So don't go for just those stocks that, doesn't have the demand yet, right? Those will be published, right? Because it doesn't justify the valuation, right? So need to make sure that you do your due diligence for the stock analysis. If you find this video beneficial to you, please give us a like and also let us know in the comment section on what other topics you'd like us to cover in the future. And do share with more people so that more people can benefit from this video as well. Yeah, and I will look at your comments to see what are the next video more people are interested in. And now we are in the earnings season, right? Potentially some review of earnings as well. Okay, and see you in the next video.